What is up, everybody? Welcome back to the Stock Trades YouTube channel. My name is Dan Kent, one of the co-founders of Stock Trades. Today, we're going to go over a very interesting and very popular ETF as of late, and that is the Horizons S&P 500 ETF. It trades under the ticker HXS.to. There's a US dollar version that is HXS.u.to. But there's a lot of people who own this fund. They probably have no idea what they actually own. That is because this fund is a bit of a unique structure, and it's really, really important that you at least understand how it functions, how it works, and how it can provide less tracking error and better returns relative to the S&P 500 without actually owning the index. And yes, you heard that right. HXS actually does not own the S&P 500. So if that's confused the heck out of you, stay tuned. We're going to explain it all in this video right now. So everybody, as always, head down below, like the video, subscribe to the channel, comment down below what fund you want me to look at next. This was a very, very popular request, which is why I'm going over it today. And as always, the No BS newsletter 2 times a week. It's absolutely free down in the description. HXS. I am going to keep this video a little bit on the shorter side than I typically do because there's a lot of technical aspects on this that is going to be a bit harder to understand, but I'm going to try to make it as simple as possible. HXS is pretty much a fund that tracks the S&P 500 that does not pay any sort of distributions. In fact, it doesn't even collect any dividends from the companies in the S&P 500. And I'm going to get into why this is after I go over the basic details here. So in terms of fees, on the surface, this fund has a net expense ratio of 0.10. However, there is a specific fee that this fund pays called a swap fee that I'm going to get into in a bit that pushes the fees a bit higher, actually 4 times this amount. So that's something to keep note of. We're going to go over that in a bit. So it has assets under management of $3.451 billion. This is a very big fund. It started in 2011. These swap-based ETFs, total return-based ETFs, they've become very popular over the years because, as I mentioned, they're tax-friendly, and also they are a great way for Canadians to get access to the S&P 500 in Canadian dollars and not necessarily have to undergo that withholding tax that a Canadian domicile fund like VFV would have to undergo even inside of an RRSP. These funds are attractive to a lot of people who've possibly had their RRSPs maxed out, their TFSAs maxed out, and they're looking for U.S. exposure in a taxable account. So they might choose a fund like this because it doesn't pay any distributions. You're essentially deferring your tax until you sell the ETF. And there is actually some situations here where this can be more tax friendly. Obviously, I'm not going to get into the logistics or the details of the tax itself because that is highly dependent on you as an individual, your personal income, all that type of stuff. However, for many, the option of deferring a distribution, which is taxable in the year that it's paid, you can have this fund essentially collect the distributions, reinvest them into the net asset value of the fund. Your total return increases, which is reflected in the actual price of the ETF, and then you can sell that for a capital gain, which is a more tax-friendly form of income than a dividend on a absolute broad-based level. Again, you have to understand it from your individual situation. I'm not here to talk about that, but that is the main benefit of this fund. No distribution, it's tax-friendly, you get a total return instead of a return plus your dividends or distributions that equals total return. If the S&P 500 gains 8% on the year and pays a 2% distribution, you are going to get 10% from this fund. A very generic example. What I'm trying to say is there's no distribution here. Total return is total return, and that's what you're getting with this fund. Now, how exactly does it do this? And this is very, very important for you to understand if you own this fund. The Horizons S&P 500 Index ETF seeks to replicate to the extent possible the performance of the S&P 500 Index total return net of expenses. So the fund has a US dollar denominated version which trades under HXS.U. I've mentioned that before. If you have US dollars and want to own this, you can buy it and not have to swap currencies. So here is the key features: the total return index advantage. So HXS is part of Horizons Total Return Index family of ETFs. They created these, I don't know, it's got to be 13, 14 years ago. And what they do is they use a total return swap contract to replicate the performance of the index. So this structure typically reduces tracking error associated with replicating an index and increases tax efficiency. As I've mentioned, I'll get into tracking error in a bit. So tax efficiency. HXS is not expected to make any taxable distributions, making it advantageous for taxable accounts where U.S. dividends are taxed at the marginal income tax rate of a Canadian resident. And automatic reinvestment. The reinvestment of index constituent distributions are reflected in HXS's net asset value on their X date, which can result in more efficient compounding than ETFs that compound only quarterly or monthly. So the most important thing you need to understand about HXS is that it does not physically hold the underlying constituents of the index. Instead, its return is delivered via swap agreements with acceptable counterparties. So in this case, major Canadian banks. And what exactly is a swap contract? Now, this is a type of derivative contract. Now, the first thing you need to understand is what exactly is a derivative. And a derivative is essentially a contract that is based on an underlying asset. So you see this a lot with options. So if you buy a call option, you have the right but not the obligation to purchase 100 shares of a particular stock or whatever else you purchase that option on at a specific price. So what you need to understand is what exactly is a swap contract. Now, a total return swap is a swap agreement in which one party makes payments based on a set rate, either fixed or variable, while the other party makes payments based on the return of the underlying asset, which includes both the income it generates and any capital gains. So if I could explain this in the easiest way possible and the simplest way possible, Horizons goes to a major institution and they agree on a rate at which Horizons will pay the bank. In return, the bank will promise to, contractually obligated, to pay Horizons the, in this case, total return of the S&P 500. So total return swaps permit the party to receive the total return to benefit from the reference asset without actually owning it. So as I mentioned, the total holdings in this fund are none. HXS doesn't actually own a US-based ETF that tracks the S&P 500 like I've gone over before. It doesn't own a Canadian-based ETF that tracks the S&P 500. It doesn't actually own the individual stocks of the S&P 500. What it is doing is it is in these swap agreements with major financial institutions. They pay a fee to those institutions, and in return, those institutions pay Horizons the total return of the S&P 500. This is why you'll see Horizons does not collect a distribution. It does not get paid a distribution from the S&P 500, despite the S&P 500 and its underlying constituents paying one. Instead, it just gets the return of the S&P 500 from these financial institutions in agreement of paying these institutions a fee. Now, what is the key underlying risk with a fund like this? Well, in my opinion, it would be counterparty risk. Now, what exactly is counterparty risk? Well, it is the fact that you are relying, in this case, Horizons, you are relying on those institutions to make payments based on the overall returns of the underlying index. Now, these are Schedule I banks here in Canada. You're talking, say, National Bank, Royal Bank, Bank of Nova Scotia, Canadian Imperial Bank of Commerce. It is very, very unlikely that any of these institutions could not make the payment, but the counterparty risk is there. The one confusing element of this is if Horizons doesn't own the underlying index, they don't own any of the companies on the S&P 500, they actually don't own anything besides this agreement with the major institution tracking the S&P 500, what exactly happens if the S&P 500 loses money? What happens in that case? Well, Horizons actually has to pay the institution. So if the S&P 500 loses a particular amount on the year, Horizons would be obligated to pay the institution that loss, which ultimately would decrease the net asset value of the fund, and as a result, the fund would decrease in value. Now that we've explained this fund and how it works in a pretty simple form, I actually want to go into how this fund has performed, and it has performed actually pretty well. So if we look to the total returns of HXS over the last 10 years and we put them against the S&P 500, and we'll go to total return, we can see that from a total return perspective, this fund has actually performed quite well. Now, the only reason you're seeing a wide outperformance here is currency fluctuations. Now, this fund trades in Canadian dollars, and the S&P 500 obviously is in US dollars. The returns are in US dollars. So if we look at HXS.U, we can see that the returns are actually quite a bit closer. When we look to the actual fees of HXS, which are not 0.1, they're actually 0.4. And the reasoning for this, if we head to the fact sheet here, we can see that the management fee is 0.1. However, it does not include a swap fee of approximately 30 basis points. So this could end up costing you 0.4. So to give you an idea on how this fund would work in relation to a fund like, say, VFV, let's have a look here. So we'll look at VFV from a just actual price appreciation standpoint. So if we look at VFV versus HXS, you can see that over a period of 10 years, it looks like Horizons has outperformed VFV by quite a bit. However, we have not accounted for distributions here yet, which is absolutely huge. If you think about it, HXS collects those distributions from the bank, which in turn increases the net asset value, which in turn increases the price of the ETF on a unit base. Whereas VFV, they collect those distributions, they pay them out to shareholders. So from a total return perspective, you're going to see that returns level out almost to identical. You're talking over the course of 10 years here, around 1.5% in terms of total return. So you're getting almost identical returns from VFV and HXS. Now, what is the key difference here? Well, it would be the fact that even in an RRSP, VFV is subject to withholding tax. This is because it is a Canadian domiciled fund that holds US ETFs or US stocks. Now, I'm not going to get into that in depth. That is an entirely different subject for an entirely different video. However, just know that the returns on these funds should be virtually identical. However, if you stick both of these funds into a taxable account, there is no doubt that HXS is more tax beneficial on a surface level. If you're looking to, defer taxes, claim them as capital gains instead of claiming those distributions when they're paid out, it definitely makes sense for you to look into. So overall, I hope you liked the video. This wasn't necessarily a fund review. It's more of an explanation on how this fund operates. It's a great S&P 500 ETF. It's going to have pretty much, relatively accurate returns to the S&P 500 and to a lot of other Canadian S&P 500 ETFs. The main difference here is how it gets there. This is a swap contract with a bank. They promise to deliver the returns of the index. That includes capital appreciation and distributions, and as a result, you get paid that without actually collecting any distributions, without being paid out any distributions, and as a result, you can sell something like HXS and claim a capital gain over something like a distribution, which you have to claim in the year you receive it. Ultimately, what you want to choose is going to be highly dependent on your overall situation. I'm not here to tell you what funds you should be buying or selling. I'm just here to provide a broad overview of them, and you can make an educated decision based on your personal situation. Again, I hope you liked the video. Head down below, smash the like button, subscribe to the channel, comment on what fund you want me to look at next. We do a contest where we're giving away premium subscriptions to random commenters on the channel. So the 5 to 10 seconds it takes to comment is, it could end up winning you a $300 a year subscription. And as always, stay tuned for more great Canadian videos.